A year ago, I stood up here, and the attitude in the hedge fund industry was very negative. You know, if you read a newspaper, it was just a constant barrage of negative information. And there were really four things that you heard over and over and over again. One was the hedge fund performance was terrible. The second one was hedge funds' fees are too high. The third is that institutional investors were abandoning hedge funds are going to get out. And the fourth one tended to focus on high-profile hedge fund managers that were closing down because the markets were too efficient, they couldn't generate returns, and they were just giving up. You know, based on these articles, you would think that the hedge fund industry was hemorrhaging assets. If you fast forward to today, we have had 5 straight quarters of record hedge fund assets. As of September 30th, the industry stood at $3.15 trillion in assets based on HFR data. So where's the disconnect? You know, many of the people in this room are on investment committees, whether it's a pension fund, endowment, a foundation. There are a number of hedge fund consultants, there's fund of funds. There's a lot of people that need to talk about why people should allocate to hedge funds. And if you're in any of those roles, one of the most important questions is, you know, what is hedge fund performance? How do you communicate it? And if you're going to communicate hedge fund performance, there's really 3 things you need to be able to communicate. One is, how do you measure hedge fund performance? The second is, what do you compare it to? And the third is, does it enhance the risk-adjusted return of a portfolio? The mainstream media, and again, there's a lot of media in this room, and I don't consider the media in this room mainstream media. The media in this room focus on hedge funds. But mainstream media likes to talk about hedge fund indices as a representation of how the hedge fund industry is doing. And there's 2 issues with that. The first is that hedge funds are not an asset class. Hedge funds are a fund structure that consists of a lot of different strategies, each of which should have their own tailored benchmark. But let's just put that aside. Let's just say, hey, we want to come up with one number to talk about hedge funds or how they're doing. What should we use? The other problem is, in using indices, is there's wide dispersion of return between indices. And I want to talk about that in a second here. So there are 3 different types of indices. The mainstream media likes to talk about investable indices. What is an investable hedge fund index? It's basically managed accounts that have a daily NAV. These portfolios, if they have illiquid securities, will not be run pari passu with a hedge fund, because you cannot have illiquid securities in a fund that strikes an NAV. The person who has these investable securities has to pick managers, so there's a manager selection bias, and a number of these funds will have high fees. It might be an administrative fee, it might be a custody fee, it might be a high investment management fee. HFR has 2 indices. One is investable, and one is your regular index. The investable index has underperformed the regular index by over 200 basis points over time. The media likes to use investable indexes because the numbers are very quick. You can see them, within a day at quarter end and write a paper. And part of being the media is getting information out as quickly as possible. The problem with using these indexes is it underreports what the average performance of the hedge fund industry has done by a significant margin. The other 2 types of indices are one that is asset weighted and one that is equally weighted. The asset weighted one is another popular one to use to talk about how the industry is done. And the problem with the asset weighted one is it has underperformed the equally weighted one over time because smaller hedge funds outperform large hedge funds. Just to give you an example, this year, the Barclay Hedge equally weighted index is up 7.37%. The HFR asset weighted index is up 4.36%, so there's a 3% difference. I mean, one of the problems of the hedge fund industry is you have too much money going to the largest managers. Preqin did a study, and it showed that 90% of assets were going to hedge funds with over $1 billion in assets, and 75% were going to managers with over $5 billion in assets. And a number of those large managers are managing more money than their strategy can optimally handle. which means that their alpha is being diluted over a larger and larger asset base, which is diluting their returns, which is why asset-based indices don't do as well as equally based indices. You know, I mentioned a 7.37% return that Barclay Hedge has done year to date. That sounds pretty good. You know, we haven't figured out what to compare it to yet, but just sounds like a decent return for the first 9 months of the year. It's especially decent because you got to remember, or at least from my opinion, I think 90% of hedge funds are not very good. 90% do not generate the returns to justify their fees. Now, I say that, and obviously I'm all into the hedge fund industry, but when I look at mutual funds, I think it's a much smaller percent that are worth the fees that they charge. When I was head of institutional sales for Merrill Lynch, we were the third largest active manager in the world. And when I was there, we had an institutional asset management group and a mutual fund group. And they merged the two together to form Merrill Lynch Investment Managers. They actually had a contest to come up with that name, Merrill Lynch Investment Managers. But it's now part of BlackRock. And part of my job was to go down to Princeton, New Jersey, where we had this huge mutual fund operation, and look at all the mutual funds. We had somewhere between 50 and 100, and figure out what we're going to sell to large pension funds. And when I went down there, I spent a lot of time. I thought there was one mutual fund that was quality enough to sell to the institutional marketplace, and I think that represents most of the mutual fund industry. So saying that 10% of the hedge fund industry is good, I think is a positive, because I believe there are 15,000 hedge funds, 10% is 1,500, and that is a lot to choose from. And all of us in this room, our objective is to find those 10%, and all of us believe we can do a lot better than the indices. So now the question is, if you come up with a specific return, and I think it should be an equally weighted hedge fund index, not an asset weighted, and certainly not an investable hedge fund index, you know, what do you compare it to? Well, a lot of the media will use the investable index and compare it to the S&P 500, typically. I say typically because that's not what they did in 2008. In 2008, the hedge fund industry was criticized for losing money. It significantly outperformed the S&P 500, but it was down. So since 2009, the S&P has gone straight up, and that's what a portion of the media uses to compare the hedge fund indices to, and obviously it doesn't make any sense. It's like comparing the PIMCO Total Return Bond Fund of the S&P 500 to the Vanguard Federal Money Market Fund of the S&P 500. You know, I would argue for an institution like a pension fund that the aggregate bond index is a better measure to compare the performance for hedge funds. Now you may say, well, Don, what does that have to do with hedge funds? Well, I've been calling on pension funds for 32 years, and a large percent of them have been clients at some time during my career. And I've also served on investment committees of pensions, endowments, foundations, and what most of these institutions do on an annual basis is they try to figure out what their asset allocation is going to be. They sit down with their investment consultant, and they like to bucket all the parts of their portfolio. You know, for example, on the equity side, they'll have a bucket for small cap value, small cap growth, large cap value, large cap growth, EFA, emerging market. On the fixed income side, high yield, core fixed income, real estate, private equity, hedge funds. And really what they're trying to do is come up with forecasts going forward with their consultant on what the expected return of each of those buckets are, what the expected volatility is, what the correlation is, and to come up with the best risk-adjusted return they can from their portfolio, to be on the efficient frontier. So with that said, on the fixed income side, the yield on the aggregate index right now is 2.55%. So when these pension funds sit down and they're doing their asset allocation, they can't use a return that much higher than 2.55%. Maybe they add 50 basis points, you know, through active management. So this is getting back to one of the things I mentioned earlier, all these stories about institutions coming out of hedge funds, and I'm going to tell you why they're not coming out of hedge funds. The reason they're not is the fixed income portfolio, they're expecting a 3% return. And that's assuming interest rates don't go up. Obviously, they have a long duration. Interest rates go up, their returns can be a lot worse than that. As long as their forward-looking returns for hedge funds are higher than 3%, they're going to stay in hedge funds and keep their current allocation. Some may actually take money out of fixed income and put it into hedge funds, especially given where valuations are for the capital markets right now. Truly, the best way to look at overall compare hedge fund performance is by having a customized benchmark. For about a year and a half, I gave or helped Bloomberg with their monthly commentary on how the hedge fund industry did. And before Kelly Bitt, who was the Bloomberg reporter at the time, called me, I tried in my mind to come up with what I thought the performance of the Bloomberg Hedge Fund Index was, so I could comment and tell her why it was what it was. And basically what I did was, when you have an index of 2,000 managers, you have a lot of market exposure. And I used to look at all these different indexes and weighted them based on kind of what the weightings were for various hedge fund strategies. So when Kelly called me, I could say, Kelly would go, well, Don, why is the index down 0.7% this month? And I could say, well, Kelly, it's because, the S&P did this, and the small cap index did this, and, most managers do have some international exposure, and bond spreads widened out, and basically, that's what everybody should do. If you have a diversified hedge fund portfolio, you should have some type of benchmark for your overall portfolio to tell how you're doing or how your staff is doing at managing the hedge fund portfolio. For individual managers, obviously, you should do the same thing. You should figure out what factors are overweighted in, and you should, in your mind, come up with what you think the manager's performance is going to be before it actually tells you what it is. And if it's drastically different, then you should find out why. For long-short equity managers, you can't look at them all the same. You can't even look at them all the same if they have the same net exposure. Year to date, the large cap growth index is up 19.3%. The large cap value index is up 8.5%. So that's 1,100 basis points difference. So if you have a long-short equity manager that focuses on growth stocks, and you have another one that's a Graham Dodd value manager, the value manager might have underperformed the growth manager, but he might have added a heck of a lot more alpha to the portfolio. And when we look at managers, that's one of the things I try to do is really understand how much of their performance is driven by the market and how much is driven by alpha. All of this is backward looking. Part of this conference is really looking forward. It's looking at what current valuations are and overlaying them with our economic forecast to figure out how you're going to allocate money. And if you have a diversified portfolio, most of your return is going to come from what strategies you're allocating to, not necessarily what managers you're allocating to. So when I look at the valuations of the various markets, the first one I'm going to talk about is the equity market. So the forward-looking PE of the S&P 500 is 17.5%. More importantly, it's a 22% premium over the average over the past 15 years. If I compare it to emerging market PE is 12.2 with a higher expected growth rate. One of the things that our firm likes a lot is Asia. And why do we like Asia? First of all, it has lower valuations. Second is it has much higher growth rates. The IMF believes that Asia is going to generate a majority of the world growth over the next 5 years. I want to repeat that. Asia represents a majority of the world's growth over the next 5 years. In addition to that, the markets are very inefficient. They're dominated by retail investors, not like the U.S. So if you look at U.S. managers, not that many have outperformed the S&P 500 over the past 5 years. If you go to Asia, some people have beat the market by a very large percent. You also in Asia have higher volatility. Higher volatility, I think, makes it easier to outperform. In the U.S., you have very low volatility, which has made it difficult for managers to outperform. If you look at hedge fund assets, again, most of the world growth is going to come from Asia. Only 4% of assets are allocated to Asia-based managers. I have a question for this room. The question is, how many people have invested in a manager based in Hong Kong that does U.S. equity? So if you have a Hong Kong manager and all they do is U.S. equity, raise your hand. There is actually one that does it. That was actually a joke. And the reason it's a joke is because a lot of people, when I ask that question, think I'm a moron for asking. Why would you even say that, Don? Of course we would never hire a Hong Kong-based manager to do U.S. equity. But there's a lot of people that have no problem hiring a U.S.-based manager to manage money in Asia. Now, maybe some of them in the U.S. do a good job. I'm not criticizing it. I'm just saying that, you know, if you want to focus on Asia, it makes sense to consider people based in Asia to do it. And it's pretty easy to do research on Asia-based managers because most of them are located in 2 cities, Singapore and Hong Kong. I want to move over to fixed income next. I mentioned before the yield on the aggregate index is 2.55%. The credit index is 3.16. The MBS index is 2.81. Corporate credit spreads are trading at, and this is as of September 30th. It may be a little bit different right now. Corporate credit spreads are 106 basis points above Treasuries. The 20-year average is 166, so they're trading tight. High yield is trading 366 basis points above Treasuries. Its 20 years average spread is 604, so it is very tight. You know, our firm's belief on credit is very positive. I think there's a lot of inefficiencies with credit. You know, for example, structured credit. You know, there may be 1,000 CUSIPs out there. It's very complicated. If you have, you know, sophisticated proprietary kind of analytics, you should be able to get a better price than the average person. Wall Street prop desks are gone, so hedge funds are really filling the void of prop desks, you know, being closed down. With that said, I don't think you want a levered, long-duration credit manager. I think you want someone who is fairly well hedged and someone who is turning the portfolio over. And I think it's a great space to get an information advantage. I think you can get a very high Sharpe ratio. I think there's possibility rates are going up, and that's what I think you need. I think you need someone who's going to be turning the portfolio over with some frequency and not a buy and hold manager. You know, there's been a lot of discussion at this conference on low correlation strategies, and they are really the bedrock of this industry. And what's very interesting is, you know, I said, when CalPERS first got out of hedge funds, our firm wrote an article, and we said that we didn't think any other pension fund anytime soon was going to follow CalPERS. It was about 18 months, and a few others got out. And you know, there was 2 very high-profile ones that reduced their allocation to hedge funds. One was the state of New Jersey, who actually has a very talented, I think, hedge fund staff. And the other is the state of Rhode Island. And what's very interesting is after they announced that they're going to significantly cut back their hedge fund allocation, they both did a search for a CTA. And they both used different consultants. So, you know, it really shows me that they're looking at hedge funds differently. Instead of just trying to outperform a hedge fund benchmark, they're trying to overweight those strategies that are not correlated with the long-only benchmark. One strategy, which I disagree with the panel that just went, you know, I like reinsurance. And it's, you know, one strategy that does have no correlation to the market. It's the risk associated with property risk does not change year to year. There's a lot of people that come to me and say, well, we have all these hurricanes, so it's global warming and it's just going to be terrible next year. And you know, we just finished like 12 years in a row with very little hurricane activity. So yes, there was a lot of hurricane activity this year. I think it's going to cause pricing to go up. The risk associated with it is not going to go up. It has nothing to do with the equity and fixed income marketplace. And in the investors that we see, it is one of the hottest strategies there is in the marketplace right now for people looking to diversify their portfolio. I want to talk about fees. So there's been a lot of discussion on fees coming down over really the past 10 years. In the first 5 years of the past 10 years, they didn't really come down much at all. There's just talk. The pressure on fees has really accelerated over the past year. And what we're seeing is a lot of hedge funds go back to, investors go back to hedge funds they've been invested in for 5 years and renegotiate their fees. I've never seen that before. But recently, that has intensified. There's a bunch of different ways that hedge funds are approaching this. One is that we're beginning to see people scale their fees. And this is something that on the long only side, they've been doing for 30 years. And basically what that means is the more money you invest, the lower your management fee is going to be. You know, they may scale it at 25 million or 50 or 100 or whatever the dollar amount is. They don't want to negotiate. They want everybody to have one fee structure. You want lower fees, fine, just give us more money. The other type of reduction in fees is really negotiated, and it's just all over the place. You know, people are negotiating, obviously, the management fee, they're negotiating performance fee, they're negotiating a hurdle rate, they're negotiating the crystallization period. And I just see that the pressure on fees is not going to go away. It's going to intensify. And although assets are all-time high, you know, fees are obviously nowhere near an all-time high right now. For smaller managers, there is the founder share. And you know, 5 years ago, there weren't that many people using founder share. Today, it is very, very common. I think the average fee for founder share is probably, you know, 1 in 10. This is really interesting. So, you know, the articles say that, you know, hedge funds have very high fees, and there are some public funds that don't like hedge funds because they have high fees. Well, I can tell you that I would be willing to bet there are some hedge funds that would be willing to manage a public pension fund for free. You know, they got 10 million under management, they got 20 million under management, you give me 300 million, I will do it for free. So fees should not be the reason you don't invest in hedge funds, because there is intense fee pressure. There are a lot of people that will do a portfolio for a low fee, but I think it's a mistake to focus just on fees. I mean, really, the objective should be to focus on the highest net adjusted returns. I want to just go back to the beginning, and I talked about the 4 things that the media was talking about last year. I just want to summarize very quick. You know, the first was poor performance. And again, I think all of us need to be able to clearly articulate to everybody we deal with, you know, what the truth of the matter is. And the truth of the matter is that often the indices that they are quoting aren't, or are underrepresenting, I think, what the average hedge fund is doing. And I think it's very important to not compare that performance just to the S&P. People need to be educated what the appropriate benchmark is to compare hedge funds to. As far as high fees go, again, they are coming down. There are some that are very inexpensive, and if you want to allocate to hedge funds, you can always find someone that has low fees, although I don't think that's a good strategy in picking managers. As far as institutional investors go, this year I have not seen one single article about an institutional investor getting out of hedge funds. I'm sure there have been some, but you got to remember there are hundreds, if not over 1,000 institutional investors, and there certainly is not a trend towards institutional investors getting out of hedge funds. And the last thing I want to talk about is high-profile hedge fund managers closing down. And there have been some. But this is a very difficult business. I mean, you got to come with your A game every day if you want to generate returns. Also, there are certain strategies that over time just stop working. So if there's some high-profile manager whose performance hasn't been good and they're closing down, that's good. They've made a heck of a lot of money. I mean, they're going to go live wherever and have a great life, you know. See you later. I mean, there are a lot of other people who, you know, are being innovative, has new strategies, and they need to take the reins going forward. So there's 15,000 hedge funds in the industry right now. There's too many. Seeing hedge funds close down, I think, is very good, and I think it's very healthy for the industry. So in general, I think things look very positive for the industry. Next year, if the market doesn't sell off, I think we're going to meet another all-time high as far as hedge fund assets go. I want to thank you all very much for coming to this conference, and I hope you enjoy the rest of the conference. Thank you very much.